Hello, fellow Rebel Capitalist Pro members. Hope you are well. I want to make this pretty much as similar as I can to the live streams that we do here on Rebel Capitalist Pro. So if you could, while we're going through this webinar, just go ahead and post any questions that you have just right here in the chat, and I'll look at those. And at the end of this webinar, I will answer those just like I would, like I said, on a normal live stream that we would do within Rebel Capitalist Pro, whether it was with me or Lynn or Chris McIntosh, Brent Johnson, etc. So just to reiterate, guys, as we're going through this, if you do have a question, just post it right in the chat here. And at the end, I'll go through the chat and answer any question that I can. Okay, the first thing that I want to do is go over kind of what St. Barts is, why I go there, and some of the overall takeaways. And we're going to dive into kind of the secrets, the strategies that I've learned, not just from this last trip, but an accumulation of all the times that I've gone there and all the interesting, to say the least, discussions that I've had. And I think at the end of this webinar, you guys, I think you're going to have several epiphany moments. And you're going to be a lot better investor as a result of the information that I'm going to reveal on this live stream webinar. So I'm super excited. What I'd like you guys to do, those of you, I think we've got 100 or so people on the live stream right now, do yourself a favor. And I would sit down, I would get a piece of paper, just old school, and a pen, remember those? And I'd take some notes. Jot these things down because you're going to want to review this in the future. And then if you, at the end, again, or while we're doing this, if you jot down a question, put it in the chat, and we'll address that as soon as we get done. So first and foremost, I want to give you guys an idea of what St. Barts is like. I mean, going back to my personal story, for those of you who are following the channel, and I know a lot of you were, you know that I got locked down in Colombia, in Medellin, and most of you know me well enough to realize that I was having none of that. I was not, I'm not going to sit here and be locked in a cage for an indefinite period of time. That's not George Gammon. That's not the Rebel Capitalist mantra. So anyway, I started looking at places that were open. I couldn't find any place except for St. Barts. My good buddy Hugh Hendry, I remember I texted him a couple times just asking him if the restaurants were open there, and he kind of texted me back like, yeah, well, like, why are you even asking? You could tell that Hugh really wasn't paying attention to the news. And once you go to St. Barts, if you've been there before, you know why. Because it's just kind of this little island. You can drive from one side to the other about 15 minutes. And it's just full of these hedge fund guys and just incredibly successful Wall Street investment bankers. It's wild, the type of people that you meet there. But anyway, going back to that, I flew out to St. Barts. I got there as fast as I possibly could. I met up with Hugh, just nicest dude I've ever met. And he started inviting me to a lot of the house parties that he was having at the time. Remember, this was COVID. So that tells you, number one, what Hugh's like. And he wanted less of the lockdowns than I did. But pretty much everyone there, it was really wild, in fact. I met a lot of Hugh's friends, not just the hedge fund manager types. But he's, as you guys can probably guess by watching an interview with Hugh, very, not only eccentric, but very eclectic. And so is his group of friends. So he would have artists over there, famous actors and actresses from Los Angeles. And I thought it was very interesting, the political spectrum. And a lot of these people were, you would say, way on the left, but they were there for the same reason I was, because they wanted nothing to do with the lockdowns. So I thought it was interesting that we all kind of had that in common. But anyway, I got to meet just some incredible people. And since that time, I've become very good friends with a lot of these guys. And they've been nice enough to share their experience, their wisdom, and their personal stories with me. And I've had a lot of epiphany moments as a result. And I think I've been able to develop a framework that's far more robust and fine-tuned as a result of the things that I've learned from these quintessential insiders. So anyway, let's start by looking at, for those of you who haven't been here, this is St. Bart's, and Josh is going to bring back some fond memories for you because we were just there. It's got 22 beaches. This is a Nikki Beach. Josh and I had several dinners here. This is Gustavia. This is the little town with and you can see the pristine water. This is the airport here, which is actually very famous because you got to fly in over this hill. And but you can see it's like when I was there with Brent Johnson, we were driving around. I was showing him all these beaches and whatnot, and just every 5 minutes he would just comment and say, "Wow, this is like a postcard. It's like a postcard." He kept saying that over and over again. But one thing you'll find, and Josh, I think you're going to get a kick out of this. If you guys watched my live stream yesterday, I was talking about some of the takeaways that I had. And one of the main takeaways is everyone has a mentor. Even these guys that I'm talking to that have made quite literally billions of dollars for themselves and their clients, these titans of the hedge fund industry, even they have mentors. And one name that you hear over and over and over and over and over again when you're in St. Bart's from guys like Hugh and all these other guys that are kind of in their 50s, 60s, kind of that age range, is one of the guys they look up to. The main guy I kept hearing was Bruce Kovner. And he was kind of like us looking up to Jim Rogers. That's that's kind of how they viewed him. They would always try to learn lessons from him. But what I didn't know, what I found this morning when I was setting up this live stream, and Josh, you're going to kick out of this. Right here, check this out. Retired hedge fund manager has sold his 2-in-1 St. Bart's estate that was listed for $67 million. And keep in mind, guys, this is an island that you can drive from one side to the other in about 15 minutes. $67 million. But who do you think this retired hedge fund manager is? Josh, what do you think?
I mean, that looks like Hugh's place to me, so I'm not too sure.
No, that is not Hugh, although you're right. It does look like his place. That would be Bruce Kovner.
Wow. Wow. That is incredible.
Isn't that crazy?
Yeah.
I didn't realize that he himself lived or is living on St. Bart's. And I actually misspoke yesterday on the live stream. I said that one of the original people to build a mansion there, which really kind of kicked this thing off, was Rockefeller. I was wrong. It was actually Rothschild. And so this estate, and Josh, you know the one, because remember where we went snorkeling?
Oh, I remember.
At the one over on the left. Remember when we were going up the trail and I said, that's the one that Rockefeller built? Yeah. I was wrong. It wasn't Rockefeller. It was Rothschild. And that was owned by Bruce Kovner.
That's kind of creepy. Yeah.
Yeah. So he bought it in 2005 and remodeled the whole thing. And there you go. So anyway, guys, if you're looking at this from this angle, Josh and I were way over. You can see my arrow. We were way over here walking up this trail, and we kind of saw the side view of it. Josh, we would have seen it from like right here. But anyway, that's the type of people. That's my point, that you're able to rub elbows with there and actually meet and get to know. And in my case, in Josh's case, actually learn from. And this information is incredibly valued. These insights are absolutely amazing. And one of the main insights is that you can use these strategies, you can use these secrets, regardless of the size of your portfolio. What we're going to be going over in the webinar today, if you have a $1,000 portfolio, it's going to be just as applicable to you as it would if you have a $100 million portfolio. Another thing that I immediately learned, pretty much the first day that I was in St. Bart's back in 2020, is that these people that have made billions of dollars, they're no smarter than you are. No smarter than me, no smarter than Josh. They're just normal guys, just Very, very normal. Now you may say, George, well, they have a PhD and all these things in mathematics, blah, 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 blah. Okay, fine. But what I'm talking about is just being smart and understanding markets and well, I shouldn't say markets because they have a crazy intellect when it comes to markets, but it's really through experience and just gaining that wisdom. What I mean is just the global monetary system, understanding how these things are. In fact, a true story here, another one that I'll share with you, is I was hanging out with Hugh, I think the first or maybe the second day, something like that. And I went there under the impression that these guys made billions of dollars because they were so smart, because they understood the system so well. And there was absolutely nothing, no value that I could possibly add. I figured that all, the George Soros, the Druckenmiller types, that they were just that good because they had such incredible mastery of the system itself. And so I assumed that everyone there was like this. And I was talking to Hugh, we were at lunch, and I was working on a problem in my head. I think it was regarding bank reserves and like the Fed's balance sheet. And you know what it was? It was if the banks can settle with something outside of bank reserves on the Fed's balance sheet. Now I know that, those answers super, super easy. But back then I was still kind of working through that in my head. So I asked you a question along those lines. Do you think banks can settle off the Fed's balance sheet? And he looked at me like I was absolutely out of my mind. And in kind of a nice way, he said, I'm not going to use profanity here, but he said, are you effing crazy? He goes, who cares? Who cares? He goes, no, I don't know when they settle. This is completely irrelevant. He goes, why are you even asking me this question? He goes, let's just assume that I knew the answer. He goes, how is that going to help you make money? That's when I started to realize that, number one, these guys have no more insights than we do. And these guys are extremely focused on one thing and one thing only. That is ROI. That's it. That's it. How am I going to maximize my return on investment? So if you are dealing with ego right now, if you're dealing with a bias, I think it's good to have conviction. And I think it's good to have ethics and morals. We talk about that all the time as far as liberty, freedom, free market capitalism. But you've got to shelf that for a moment, I think, when you're actually focusing on constructing a portfolio. You may think that sound money, as an example, would solve all of the world's problems. And you may be right. But that doesn't mean that 100% of your portfolio should be in gold. You may think that the U.S. economy is doomed to fail and that all these policies are absolutely insane and that as a result, the U.S. economy is going to collapse or something like that. And you may be right, but it doesn't necessarily mean that you should go out there and short the S&P 500 right now. You see? So that's one of the first lessons I learned. But now let's get back to Bruce Kovner for a moment, because we talked about him yesterday, but I want to share some other insights. As I was reading, and I've read the Market Wizards book several times, but it's crazy when you go back and reread it, how many things that you discover that you kind of just glazed over before. And one of them is right here. We talked about yesterday how Bruce Kovner liked to be very, very low key and under the radar, which you'll find that most of the best guys, or the most successful guys as far as return, they would fall into this category. But that's not what I want to focus on here. Check this out. He said for about a year, and this is Jack Schwager, who is the author, who did all these interviews describing, kind of doing the write-up before you actually see the interview. So what he's talking about is Kovner's background. So he says Kovner immersed himself in studying markets and the related economic theory. He read everything he could get his hands on. One subject he studied intensively was interest rate theory. And here's a quote from Bruce Kovner. I fell in love with the yield curve. Now, guys, how often do we talk about the yield curve on the Rebel Capitalist channel? You guys know we talk about it constantly. And I think that's the elephant in the room that all the talking heads on CNBC completely ignore. But what's very comforting, at least to me, is knowing that this is something that I put such a high priority on. And the guys that I look up to and the guys that I'm learning from, like these guys in St. Barts, the guy that they looked up to also prioritized the exact same thing. And this led to him quite literally making billions and billions of dollars. And as we read yesterday, a compounded annual return over 10 years of 87%. 87%. So now what I want to do is go down to page 35. And usually I just kind of wing it on these things, as you guys know, but I actually did some homework here, believe it or not. So he goes through his process. And this is something I really want you guys, if you're going to write down one thing or have one takeaway from this webinar, I think this is probably what it should be. Because I get questions all the time with, bottoms up type questions. Should I invest in this company, what's this balance sheet? And I think that's great to do that type of homework and be cognizant of that. You have to understand these things. But I don't know that should be your main priority. Or, well, let me put it to you this way. It's definitely not my main priority. And all these guys that I've learned from in St. Barts, it's not theirs either. Their process is exactly the process that Bruce Kovner reveals to Jack Schweiger in this interview in the Market Wizards book, the original. So let's go over this. Jack Schweiger asked him, do you use fundamental analysis forming your trading decisions? Bruce said, I almost always trade on a market view. I would call this a macro view. I don't trade simply on technical information. In other words, he doesn't really trade. He wouldn't trade not only on the technicals, the charts, but he also wouldn't trade just exclusively based on company XYZ's balance sheet. So he starts with a 30,000 foot level view, and then he works down from there. He doesn't do the opposite. Now, I'm not saying doing the opposite is wrong. I mean, Warren Buffett would probably fall into that category, someone who's obviously been extremely successful doing that. But for me, this is kind of my default. This is what I think this feels more natural to me. It makes more sense, right? And so this is something you might want to consider. But he goes on and says, so this is Jack now, is that to say that virtually every position you take has a fundamental reason behind it? He says, I think that's a fair statement, but I would add the technical analysis is often clarify the fundamental picture. So he gives an example here of one of these trades that he made on the Canadian dollar. So now I think that when Jack is asking fundamental, he's not talking about XYZ's balance sheet. He's talking about a fundamental macro view. I want to make sure that we differentiate there. So Bruce talks about how he made this US-Canadian dollar trade. And at the time, he was caught in the middle. He didn't know. It was kind of like a 50-50 coin toss. Like he didn't know what was going to go up, the US dollar or the Canadian dollar, but I guess he wanted to make a bet. And so then what he talks about here throughout the rest of this paragraph is the process of going through the fundamentals, the macro fundamentals for the dollar or the Canadian dollar, and then forming a view, and then going to the charts and having the charts tell him where the best entry point was, or have the charts back up his fundamental view. So I think that's absolutely crucial, because that's one of the processes. That's one of the things that we did when I was there, not this last time, but the time prior, for this macro camp with all these other hedge fund managers that were there specifically to learn from Hugh and his kind of OG legend buddies. One of the kind of practice drills that we did was take this exact same approach. So right now, as an example, I would start with the inversion of the curve. Let's go right back to what Bruce Kovner was talking about earlier. You've got to imagine if Bruce Kovner was still in the game right now. I mean, ask yourself, just based on this interview and based on what I would call his students, these guys that I'm learning from in St. Bart's, you've got to ask, what would they be doing right now? And even based on this interview, you know darn well that Kovner would be hyper-focused on the yield curve, and he'd be making his decisions based on that. He'd be looking at the technicals, if you will, based on that. He would try to decide how he wants to make that bet. But he wouldn't just do all this research himself. He would have a team around him, a research team, research analysts, and he would sit there and say, okay, I've got this worldview. I think the inversion of the curve is going to play out like this because it has every single time in the past. Therefore, what's the best way to play this? Understanding risk and reward. You see? So what's the best risk-reward play on an inversion of the yield curve? What's the best risk-reward bet? And that's kind of the practice routine, the practice drill that we did in St. Bart's with all these other up-and-coming hedge fund managers. And that's what I would encourage you to do as well, or at least try out to see if that's a good fit with your personality. Okay, guys, now let me look at my notes here. All right, the next person I want to talk about, and I can't really reveal his name because, like Kovner, he's someone that likes to keep a super, super low profile. But he was one of the top hedge fund managers in emerging markets in the late 1990s and into the 2000s. Really, really good buddies with Jim Rogers. And I didn't know that when I first met him. Actually, I met him at one of Hugh's house parties there because Hugh thought we'd have some things in common. He says, well, we'll just say that we'll just call him Steve. That's not his real name. We'll just call him Steve. So he says, oh, George, come meet my buddy Steve. He's really into macro as well. That's pretty much all he said. I'm like, oh, okay, great. So we went over there and I was just talking to his buddy Steve. We're having a beer. And he's like, he kind of asked me what my backstory was. And I'm like, well, most of you guys know this. I retired in 2012. And after I retired, I wanted to manage my own money. I didn't want to delegate that to a financial planner. And so I started investing in real estate because the one mentor, I guess, if you will, that I had back then was Jim Rogers. And as you guys know, he teaches us to buy things when they're cheap and sell them when they're expensive. And back then, relative to the cash flow, real estate was extremely cheap. So I was telling Steve that, oh yeah, I did this in 2012 and I started buying houses and I was cash flowing them in this portfolio. And he says, oh, George, that's crazy. Such a small world. I was doing the exact same thing. I said, wow, that's really cool. And at this time, I'm thinking I'm a big shot. I'm feeling really good, right? My future's so bright I got to wear shades because I'm rubbing elbows with all these big shot hedge fund managers. I'm there in St. Bart's for the first time and I'm hanging out with all these super famous people at this party. I mean, my ego's about the size of this room, right? At this time, I'm really thinking I'm something special. I'm like, wow, George, you've made it. You are really, really cool. And Steve says, well, how many houses did you end up buying? I said, oh, I don't know, maybe 20, something like that. And I just wanted to be polite. I'm like, well, Steve, how many houses did you end up buying? He kind of takes a sip of his beer and he thinks about it. And he's like, around 1,500. And I went from thinking I was about this big, and then all of a sudden the ego goes, boo, and shrinks down to about that. I got a dose of humble pie. I was just a great story and something I'll remember for a long, long time. But then we continued to talk And to come to find out, he was one of these very successful hedge fund managers. And I told him what I do on YouTube. And at the time, I was a little embarrassed, to tell him that because I was still under the impression that these guys were just incredibly sophisticated. And that's why they had made all this money. But then what happened is about a week later, I went to another one of Hugh's dinner parties or whatever. And this guy, Steve, was there. And he came up to me. And he's like, man, I just been watching your YouTube channel nonstop. In fact, his wife was there at the time too. And she came up to me, and we've all become very good friends. But she came up to me and she's like, you've got to stop doing these YouTube videos. I'm like, I start laughing. I'm like, why? She goes, it's driving me crazy. She goes, every single morning I wake up, and Steve, all I hear is your voice nonstop. So I come to these stupid parties and I hear your voice. I go home and I hear your voice again because Steve is watching every single one of your whiteboard videos. So that was where, and then that, along with the conversation that I had with Hugh, is where it really started to dawn on me that these people have no greater level of sophistication than anyone on this live stream right now. So again, if they can use these strategies and these insider secrets in this framework, if you will, to make billions and billions of dollars, or to make 87% returns, then even if your portfolio's $1,000 or $10,000 or 100,000 or whatever it is, you can implement these exact same things. You have the ability to do that. So don't think that they have some special intellect or understanding of the system that you don't have. All right. Next thing, we'll talk about Steve again. And Steve ended up telling me a story last time I was there that I didn't even realize that in fact, Josh was there at dinner as well, that he started his career in Japan in the late 1980s. And he saw the whole boom. Then he saw the bubble bust, and he saw it all the way down. And he was taking positions on the way up, and he was taking positions on the way down. And then he told me that in the late 1990s, he moved, or this was actually in the mid 1990s, he moved from Japan to San Francisco, the heart of the dot-com bust. And he took what he learned in Japan and he applied that to the dot-com at the time bubble and then the bust. And he did the exact same thing. He rode it on the way up and he rode it on the way down. Now, on the way up, he knew that it was a bubble, but he said that he wanted, again, ROI. It's a bubble. So what? It was his attitude. He goes, do I believe in this stuff? Do I believe in pets.com? Hell no. Hell no. But I see a massive opportunity here. So he was actually, the way he was getting into this was very interesting. And Josh, chime in here if I leave out any part of the story, because I know you remember this like it was yesterday. What he would do is he tried to take his fund and focus on the transaction side of these companies going public. And I don't know exactly how he was doing it, right? But he somehow was helping a lot of these .com companies go public. And then what he was doing is he was doing it for free or very, very low price or something like that. But he was doing it for equity. So he would say, I'll help you go public. I'll let you utilize my sources or my resources with Goldman Sachs and all of these things. And I'll help you get it done, but you need to give me whatever, 5% equity. And you need to give me those shares. So he was getting all of these shares on the cheap, if not free, just so they could utilize basically his black book, his network, right? And the expertise that he offered along with the expertise of his network. And then what he was doing is when they would go public, as soon as that expiration period was up, I don't know what it is, let's say 6 months, he would immediately sell. Immediately, because he knew the company was garbage. He knew, but he would try. So I think that the moral of that story is, number one, Steve seems to be at the right place at the right time over and over and over again, Number two, he is able to recognize a bubble, a boom, and a bust based on what he learned in Japan. And he realized that it's much better to not be a gold miner, but sell them the picks and shovels, especially when you're in the boom phase, let's say, of the bubble. And then on the way down, I don't know if he was shorting anything. Based on what he's doing now, I almost guarantee you he was buying long dated treasuries. And this would have been back in, let's just call it 2000, something like that. So on the one hand, he's doing all these services, if you will, to get the equity cheap and then just flip it. And on the other hand, he's hedging his bets and playing the crash by buying along into the curve. Now, he didn't tell us that story, but based on what he's doing today, which we're going to get into in a moment, I would assume that's what he's doing. Josh, do you think that's fair to say?
Yeah. Are you going to be able to say what he's doing today?
Sure.
Because I that's what I think everyone cares about right now.
Yeah.
Well, and just for some context, this guy, one of the craziest things that he said was there was a good stretch where their firm just printed money. So what he said is he hired someone full time, and they had the job of director of fund. And I think
he called him the CFO. He called him the CFO.
Yeah, and I think me and George both
officer.
misheard him. And he was like, director of fund? What do you mean? No, director of fund. At the end of market close, her entire job was to make sure we had the maximum amount of fun, and she had zero budget.
That's what he said. He literally said she had an unlimited budget.
Yeah, and so, I mean, he said she was spending upwards of $80,000 per day for him and like 13 of his employees. That's all he had working for him. 13 guys that were spending 80 grand a day just to have fun at the end of market close. So
yeah,
I mean, I don't know how much money they were making.
Like, well, remember he said that she would like somehow like rent a private jet to bring in lobster from like so you know, it was fresh from that day or something like that. You know, I mean, it was at that level. Okay, so now let's fast forward to what Steve was doing during the .com bust. And now at the time, I believe he was still in San Francisco. Or I'm sorry, not .com, GFC. At the time, I believe he was still in San Francisco because I think he was there until he retired. But he told me the story of how he sees the whole entire market collapsing this is residential real estate, in 2010, 2011. And so he's like, look, this is the no-brainer of all no-brainers. It's like, people are going to have a place to live. I need to go absolutely all in. So he set up this huge fund. And that's when he was out there buying all of these homes, pretty much doing the same thing I was doing, but on a massive level and at huge scale. And he actually held those properties. I believe it was they probably had a 5-year lockup, I'm guessing. So he started selling, I would assume, in like 2016, 2017. And I don't even want to know how much money he made on that. But I mean, it had to be in the hundreds of millions for sure. But he took the same concept that he applied in Japan and during the .com bust, where he recognized the bubble going up. Now, going up, I don't know how he played that. He didn't tell that story, but he just showed us how he played it on the way down. And then he did the exact same thing during COVID in March of 2020. Remember that, guys, when commodities were just basically going to zero, in fact, going under zero. When you look at oil being at negative $38 a barrel, and he was buying that hand over fist, commodities. Then, of course, crypto, you guys heard that story where he found that arbitrage play with the Grayscale Bitcoin Trust. Now, I know a lot of you commented and say, George, well, this isn't applicable to me because I'm not, at that level. Therefore, I couldn't get those shares at NAV like Steve was getting. But that's not the point. The point is understanding the concept behind what Steve does, because that's something that, again, you can apply to your portfolio, even if it's $1,000 or 10,000 or 100,000. It's understanding the ideas, understanding the concepts, and understanding the psychology that has made these people incredibly successful. All right. After Steve told me those stories, I started asking him other questions because I really wanted to get to the bottom of this. And I wanted to understand the main takeaways that he had from all of these experiences that he was sharing with us. So he sat there and he thought about it for a while. And he's like, you know what it boils down to? He says, what I've noticed since Japan is every 10 years or so, you get a generational opportunity. That's how he phrased it. He said, then once every 3 to 4 years, you get kind of a softball pitch. That's right in your strike zone. You're going to knock it out of the park. All you have to do is take action and recognize it. He says, then in all of those years in between, when it's not a generational opportunity or a softball pitch, he says, just don't do anything. That's literally what he said. And as soon as he said that, Jim Rogers came straight to my head. Because remember, Jim Rogers says, don't do anything, just be patient. That's most retail investors' big problem, is they want to always be doing something. He says, just wait till a big pile of money is sitting in the corner and go pick it up. And so then I asked him, I said, Mike, okay, so look, you're managing money, you're hyper-focused on ROI. There's no way that you're just doing nothing for 2 to 3 years while you're waiting for that generational opportunity or that softball pitch. He's like, no, that's not what I'm saying. He said, when you're in all of these other times, he says, you're just hyper-focused on risk. He says, what I'm saying is, in the interim, make sure your number one priority is managing downside. He says, try to beat the market. Absolutely. Try to shoot for those 15, 20% returns. But make sure that your number one priority is managing your downside risk. Because if you manage your downside risk well, and if you just beat the market, by a few percentage points, and you take advantage of those softballs, and you take advantage of those generational opportunities, he goes, that's where you're going to get 90% of your gains. He goes, that's what's going to take you from being a normal investor to Bruce Kovner. That's what's going to take you to being an average investor to being Steve, right? So what's really exciting about this is right now, Steve sees a generational opportunity. The once every 10-year opportunity. He sees that right now. So you say, George, well, what could that possibly be? And now I'm going to share it with you. A lot of you aren't going to like it, but it is what it is. I don't shoot the messenger. And I'm not saying that this is a generational opportunity. I'm just sharing with you what he told me. And I think this eccentric has it, nailed it right on the head. It's TLT. It's TLT. Long TLT. So now I know a lot of you are kind of fit into that category of individual that we talked about earlier. And I think I would too, where you see these deficits, you see all the profligate spending of the United States government, you see all the stimmy checks, you see just quite literally the deterioration of a society, of an empire, right? I think you see that pretty much every single time you go to Walmart now and you see everything locked up. Because I was just reading a story about how Target has reduced crime to a significant degree because they're basically locking up all their stuff and you got to ask for it. It wasn't like that in the 1980s. It wasn't even like that 5 years ago, for heaven's sakes. So we can see this playing out right in front of our eyes. We know how this ends, right? And to a certain degree, you're pissed off about it. I mean, I'm the same way. I mean, I'm an American. I would love to see America do what's right. It's one of the reasons why we have these channels and we do all the videos. But at the end of the day, you know that what they're doing is destroying the country. And it's going to destroy the economy. So I think it's very easy to always want to bet against the S&P because you know from a fundamental standpoint, it should crash. You know that it's just propped up by the Fed's psyop. You know that it's just propped up by stimmy checks, or you know that it's just completely unsustainable. And at a certain level, you want to profit from that decline because you want to profit from, hey, I'm right. I saw all this stuff when my friends and family member Freds were completely ignoring it, and I was smart enough to short the S&P 500 at the right time. I see this constantly in Rebel Capitals Pro and with the comments on social media. But I think, and I completely empathize with this, but I don't, for me, that's not the right way to play it. Do I think the stock market will go down? I think that's definitely my base case, especially when we look at the inversion of the curve. We're going to go back to that in just a moment. But for me, I would much rather take the Steve play. If I'm bearish on the S&P 500 or the NASDAQ, I'd much rather express that bet through long TLT. Now, again, this is not investment advice. I'm not saying that I'm even doing this myself. I'm not even saying it's a good idea. Because at the end of the day, the underlying asset, the TLT, is not cheap. When interest rates on the 10-year at 4.5%, prices are not cheap. But this is just a speculative play. And again, this is just explaining kind of Steve's rationale as to why Steve himself isn't shorting the S&P 500. Why is Steve not shorting the NASDAQ? Why is he playing a stock market crash through long TLT? Here's why. Because the Fed, as you guys know, can come in with their psyop, because I don't think mechanically bank reserves do anything, but they can bail out the system. So where you could have this crash, but the stock market might not go down because of the intervention from the central planners themselves, be it the central bank or the government. I mean, if we have a crash, let's go back to GFC. We know that every single time we have a crash, they make the response faster and larger. Just compare GFC to cerveza sickness. That's a perfect example. Or .com to GFC to cerveza sickness. So why should we assume that this trend won't continue? I think that we should. They're not now. It is a little different now because we do have inflation. So they're trying to bring that down. So I think they would be willing to accept a little bit more pain. But will they in 2024 when it's an election year? I don't know. Something to think about. But you understand my point. If the stock market goes down by 20% and you're super excited about this because you're short, let's say the S&P, let's say you bought puts or something like that. And you're super excited because you're in the money, you're making all this money. And then all of a sudden, the government comes and announces a CARES Act 2.0. And the market rips higher. And within a week, it goes from down 20% to up 10%. Now, all of a sudden, you're getting your butt handed to you. But in that environment, what happens to interest rates? They go straight down. They go straight down. So if we have a crash, I think the safest way to play that, if you want to play it, I'm not saying that you should, and I'm not saying that I am, but if you want to do that, and this is Steve's mentality, this is Steve's strategy, and he's calling it a once in a generation opportunity here. And I asked him specifically, I said, do you think this is as big of an opportunity as real estate was in 2012? And he said, yes, unequivocally. So I think that's a much better way to play a recession or a stock market crash, etc. And this is what the yield curve is telling us, right? That goes back to Bruce Kovner. So let's, for a moment, look at the curve itself, just the inversions here. Because another thing that I found fascinating is if you look at the inversions, it's not like it's every 10 years, but it's darn close. It's darn close. So it's almost like you could peg these generational opportunities that Steve was talking about to the inversion, which goes right back, which makes sense because this goes right back to what Bruce Kovner was saying, who effectively is Steve's mentor. You see, all of this stuff, you can connect the dots here. It's very easy to do. So we had an inversion, 89, inversion, 2000. Darn close to, to 10 years. And then we had another inversion, 6. Okay, so now we've got 6 years. We'll call it 6-7 years. And then from there, we go, let's say it's called 2007. We go to 2019, so 12 years. So it's not perfect. And then now we got a massive inversion. So it's not a perfect theory, but again, it's all about the concepts, right? And I think what we can say is that every single time we had an inversion, at least going back to 1980, that was a generational opportunity. You say, George, what was the generational opportunity in 80? How about stocks and bonds? The stock, look at the Buffett indicator, for heaven's sakes. I mean, that's the market cap to GDP. That's like at an all-time low or very close to it back here in 1980. I mean, stocks were insanely cheap when you look at the overall PE of the S&P 500. And we know bonds were cheap for sure. Right? So you say, okay, George, what was the generational opportunity right here? That would have been real estate, believe it or not. And most people forget this. And Josh would, Josh was born in the 2000s. This wouldn't even be on his radar. And even for me, I was so young back then, I wasn't even really paying attention. But if we go to the charts, we can actually see. Look at this. Look at what happened in the 1980s to real estate. Tell me that doesn't look like the exact same chart of, call it 2000 to 2006. It's almost identical. Now, it didn't go up to the same degree, granted, but it did go up way above the historic trend line. Now, this is real prices adjusted for inflation. So you can see that this run up right here that we had in real estate maxed out. When? That would be the inversion. And then what did it do? It went right back down to its historic trend line. Pretty much exactly what it did from, call it 2000, late 90s to 2006, and then from 2006 to 2012, right back to the historic trend line. So this would have been the generational opportunity. And if you want to use another thought experiment, just think what would have happened if you would have bought 20 residential homes, starter homes in good neighborhoods and cash flowed them in 1995. In fact, let's just, keeping with that mantra of buying things when they're cheap and selling them when they're expensive, you would have bought them roughly in 1995, and then you would have sold you probably would have started selling here. I would have. And I would have missed this whole thing, this whole move higher. But look at how much money you would have made, even if you would have held it from 95 or so to, call it 2003, when you got significantly higher than the last bubble. So most people, it's off their radar, but I think that real estate back then was almost as great of an opportunity, definitely a generational opportunity. It was almost as significant as 2012 in terms of real estate. But now we go to the S&P 500 and we see, once again, exactly what Steve was talking about. We look at the dot-com bust, boom and bust, and we see that once that curve was inverted, remember 2000, what happened to the S&P 500? It went straight down and it bottomed out under 1,000. This is probably just a monthly chart or something like that. So that would have been a huge, quote unquote, generational opportunity to buy. Same exact thing when we had the yield curve invert in 2006, 2007. Right? So I think the good news is that we are likely in one of these generational opportunities. Why? Because of the yield curve. The yield curve is once again inverted. And it seems like almost every single time this happens, you get at the very least a softball pitch, as how, just using Steve's terminology. And we're living through that right now. So is it the TLT, long TLT? I don't know. That's his bet. I'll let you be the judge. But again, it's not necessarily. I think the value here isn't necessarily the stock picks, but it's understanding the rationale. It's understanding the concepts. It's understanding how these people think and what drives them to take action, and then use that to build your own framework and your own portfolio. And one thing that I'd like to add to that, and this, I'm just looking at my notes here, guys, so bear with me. This is something that Josh and I were thinking about. I believe this was a conversation we had in St. Barts. Josh, correct me if I'm wrong. But after having these dinners and these amazing conversations, and after Steve was nice enough to reveal these insights to us, I started to think about TLT, and I was like, Josh, and to be very, very clear, and I know I've said this many times, but I want to be, just at the risk of beating a dead horse here, I am not long TLT. I'm not long TLT, and I'm not suggesting that you go long TLT. I'm just sharing information and stories with you. But one of the thought experiments I did with Josh, I'm like, okay, if I was to go long TLT, how would we time that? And is there a way to time that based on the yield curve, so we're not just having to just get our faces punched in by being too early? And that's another thing Steve said to me, is that he has noticed throughout his entire career, like Jim Rogers, that he's always early, always early, always early, always early. And therefore, if he puts on the trade and it goes against him, that makes him more confident that he's right, ironically enough. And I think that in and of itself shares a lot of what makes these very successful hedge fund managers tick, from a standpoint of their psychology and their overall belief system in their own ability. Whether that's justified or not, I'll let you be the judge. But so I thought, okay, Josh, understanding that Steve's always early, I get it. I think I would fall into that category as well. You have a tendency to do that. So how could we leverage the yield curve to maybe time this a little bit better? So what we did is we went back and looked at the interest rates on the 10-year. Josh, and help me out with this one. We looked at the interest rates on the 10-year after the Fed drops rates for the first time. Was that correct?
Yeah, you had me backtrack every single time the Fed would cut rates. What would the leading indicators of long-term interest rates do before the Fed cut rates?
And then what would the actual interest rate on the 10-year do after the first rate cut?
Correct. Yeah.
Yeah. And I think the conclusion that we came to is that more often than not, the 10-year interest rate went down.
Yeah, it went down, but not initially, not at the very second the Fed started cutting rates. So kind of what Mike was talking about, because I think the reason why we want to look at that is because he said there was always another opportunity to get in, even if you missed the first initial jump.
No, he's talking about that with real estate. We're going to get into that in a moment. Remind me to get into that. In fact, let me write this down here, because I wanted to share that with everyone here. Let me write this down. Okay. But what he was talking about with the TLT was specifically that he wanted to be in early because he didn't know when he'd get the biggest move.
Yeah.
So he was happy being early, even though he was getting punched in the face, because he knew that the end game was that interest rates would be a lot lower, even if the trade was going against him significantly from the time he first put it on.
Yeah. And then
what we were trying to do is we were trying to figure out, okay, well, how could we maybe time this a little bit better? So we went back throughout history and we kind of back tested it, if you will. And we saw that I forgot if it was 60%, 70, 80%, something like that. But it was a good portion, a good majority of the time. When the Fed first cut rates, the 10-year went down. So what I'm saying here is what you could do if you were really trying to manage your downside risk is you could say, all right, I'm going to just T-bill and chill. We talk about that all the time, but I really want some alpha. I really want to take advantage of one of these generational opportunities. But what I'm going to do is I'm going to sit back, do nothing, but I'm going to wait until the Fed drops rates the first time. I'm going to wait till they drop rates the first time. And when they drop rates the first time, that's when I'm going to go ahead and take action. That's when I'm going to build a position, as an example, long TLT. Now, our friend in St. Barts, again, Steve, we'll call him, I know what he would say. I know him well enough. He'd say, yeah, but you don't know if you're going to get the most juice out of the bet prior to you can't time these things. So since I already know the end game, and I'm very happy, being in at 4.5 when I know rates are going to go down to 3 or go down to 2 or something like that. So if in the interim rates go from 4.5 to 5 or 5.5, I could care less because if I wait for the Fed to drop, well, then maybe I'm going to be in at, let's just call it 4 instead of 4.5, and I'm not going to maximize on the bet. I know that's what Josh, don't you think that's what he'd say?
Yeah, but I think he would also say that he's looking at this from an 18-month time horizon.
Yeah,
so
yeah.
What the hell would you care about trying to time anything when your time horizon's almost 2 years?
Yeah. Good point. And I think one of the ways he did play it was he was buying I think he was buying calls on the TLT, wasn't he?
Yeah, but he said specifically 2 years out. I remember he was saying that, hey, if you're going to do this for a few months, you are going to get your ass handed to you. That is not the right way to do this. Like, you need as much time as possible because you don't know. Like, have you ever met anyone who could predict a macro event happening in a few months? Right. It takes years for macro events to play out. So why do you think that you can time that in a month or two?
Yeah, he might have even been buying 2025.
That's what he was doing, the 2025s.
He was buying 2025 calls on the TLT.
Yeah.
And that's a great point. That's a great point. So even as good as this guy is, he still is giving himself a huge window for this to play out. Okay, next thing that we learned from Steve, and this was, we were kind of going over some of the main takeaways from his entire career and trying to crystallize that and distill it down into just like key talking points, if you will, or certain keys or fundamentals, strategies. He said throughout his career, the best investments he has ever made as far as return have been the ones that are the hardest to buy. And what he meant was the hardest psychologically to buy. So the example I use here is going back to April of 2020. Remember, that's when oil was at negative $38 a barrel. But how many of you on this live stream right now bought oil producers in April of 2020? How many of you? It was negative $38 a barrel, guys. I think you guys understand my point. Now, some of you may have bought, but very, very few. Why? Why didn't you buy? Or why didn't your friends and family member Freds buy? Or because everyone thought the world was coming to an end, quite literally. So if the world is coming to an end, let's rewind. Let's just imagine for a moment that we're in April of 2020. The world, who knows, they're canceling the Olympics, they're canceling the MLB, they're doing, it's just, all these people are walking around in hazmat suits. I mean, this is crazy sci-fi stuff. We think, we might be living in caves eating canned goods within the next 6 months. If you think back to those times, even I was like, this is bananas. I mean, this is bananas. We live in this police state. I mean, the economy could make the Great Depression look like a picnic. So at that time, you can understand why, if I would have come out on a live stream and said, hey guys, I think you should buy oil, half of the people on that live stream would have told me that I'm insane. That, George, I unsubscribe. You've lost it now. Are you kidding me? The economy is going to collapse. The price of oil isn't going to come back for decades, if ever. We're going to go into a 20-year Great Depression. I mean, that was like almost the mainstream narrative. And I think rightfully so. Rightfully so. But you see, and we go back to 2012. When I told my family members, they're like, oh, George, what are you doing? I'm like, well, you know what? I'm actually going to start managing my own money. And I think I'm going to start buying real estate. They said, what? Are you out of your mind? You're going to buy real, like a house? I'm like, yeah, like a single family home. Haven't you seen what's happened over the last 6 years? We had this thing, called the GFC. You don't remember that? Housing prices have gone down and down. Nobody wants a house right now. Nobody's buying a house. Are you kidding me, George? Everybody knows that the housing market is never going to recover, ever. Prices are going to continue to go down. And they would give you all these fundamental reasons as to why the housing market was going to continue to decline in price. I'm sure most of you remember that. I mean, I'd ask the same question. How many of you were out there buying houses in 2011, 2012? And I'm not saying that to be critical. I'm simply saying that to prove the point that the best investments are almost always the ones that are psychologically the hardest to actually pull the trigger. So why does that matter? Because we need to start now in disciplining ourselves from a psychological standpoint, mentally, to make sure that we are ready to take action when we have that generational opportunity. Because I can assure you, it's going to be tough to pull the trigger. It absolutely is. So if you can understand that going into it, you can be better prepared, and the probability that you make the right decision is going to increase massively. So what we did after that, after Steve shared those insights with us, he said, let's go through a thought experiment. And he asked me point blank at dinner. He goes, right now, what would be the hardest thing psychologically for you to buy? The one thing that you'd be like, no way am I buying that. Absolutely not. Are you crazy? What's the one thing that would give you that type of immediate reaction? And I thought about it for 2 seconds. Didn't take me long. And I said, commercial real estate. He goes, exactly. There you go. And I said, okay, and I asked him, I said, Steve, are you buying commercial real estate right now? He goes, no, I'm not. But he said, it's definitely on my watch list. And he goes, the beauty of real estate is it takes a long time. So you can just sit back and wait and wait and wait and wait and wait. And you can see the bottom really flattening out, and then you can go ahead and get in at a price that's justified based on the cash flow. Because it is true. I mean, the first thing that people are going to say to you is, oh, people are never going back to work. We just got the Zoom generation, the Joshes of the world. They don't want to work in an office place. No. Office space is never coming back. But right, based on today's prices, but based on tomorrow's prices, the few tenants that are still there, or let's say the occupancy rate goes from 80 to 20. Okay, fine. But at a certain price, even at a 20% occupancy rate, it's attractive. It's cheap. The cash flow makes sense. So what he did say is he's just sitting back and waiting, and then he's going to play it exactly like he played residential real estate in 2011, except this time he's retired, so he's not going to set up a fund. He's going to do this with his own money. He's going to look at office buildings in San Francisco. I know San Francisco. He goes, that's exactly what I'm looking at. You got all these homeless people, drug addicts. You got people taking a dump out on the streets and all this. And he's like, yeah, great. That's exactly what I'm looking for. That means that it's going to be cheap pretty soon. So this is another thing that he's doing, and another one of these potentially generational. I don't know if he'd categorize that as a generational opportunity or just one of these softball pitches, but it's definitely something that he is really paying attention to. And the insight that he shared there, and I actually looked at charts of 2007 to 2012 or so, and he's right on the money. It's very easy to do. Well, it's simple. It's not easy, right? And this, from the standpoint of, he said that with residential, it really tanked in the first couple of years, but that it didn't bottom out for like 6 years. We talk about that all the time. And that even if you would have waited for it to bottom out, if you would have waited another 2 years, it still would have been a great investment. So just giving you specific years, I think in 2009 or so, like housing went down by a huge amount, like 18, 20% year over year. And that was the biggest year of decline. And then the next year it was like 15%. And the next year it went to like zero, like 2011 or something like that. I think the declines were actually even zero. And then in 2012, it went down a little bit before it started to go back up to the positive year over year. So if you can just wait for that, the biggest decline to where it starts flattening out with real estate, that's how you can time it and make sure that you're maximized, on your risk reward. With TLT or stocks, obviously the timing is quite a bit different there. But the point is it moves very, very slowly. So this is something, just learning from Steve, believe it or not, I mean, every single molecule in my body is saying, stay away from commercial real estate. But I'm not buying, to be clear, but it's definitely on my watch list because that makes sense to me. It makes sense that the best investments are almost always the ones where it's hardest to pull the trigger. So now what I want to share with you is I want to share with you the 5 fundamentals of investing that I have created for myself, and basically sourcing information and wisdom and experience from all of these legends. And a lot of these legends I've been so lucky enough to actually meet, hang out with, learn from, and I would consider them friends. So number 1 and 2, you guys are going to know this, but it's worth mentioning for those of you who might be new to Rebel Capital's Pro or new to the channel. Number 1, you got to buy things when they're cheap and sell when they're expensive. Buy low, sell high. And especially with commodities, which is something we're going to talk about in a second here, I'm very bullish on that long term, the commodity super cycle, if you will. And I'm hoping that we're going to get one of these softball pitches in 2024 with commodity prices coming down as a result of demand crashing, but yet that supply side story is going to be very favorable, possibly even going into the 2030s, because these long-term super cycles last, 12, 15 years. So next, hysteria, panic. So you want to sell hysteria, buy panic. A great example of that, and a lot of you might not know this because I don't tell the story very often, but I was following Doug Casey, and I would consider him another mentor of mine. He was one of the first people that I really started to listen to, Doug Casey and Jim Rogers. And they were talking about crisis investing, and this would have been back in 2013, 14, something like that. But at the time, it was all about Cyprus. I don't know if you guys remember that, but the Cyprus stock market, because they did like a bail-in with their banking system, and the stock market went down quite literally by 99%. And I heard Doug Casey talking about it. So I'm like, it makes sense. Jim Rogers buys stuff when it's cheap. That's definitely cheap when you look at the P ratios and the cash flow. And so I set up an account there and I bought shares in some companies there, but mostly in this hotel, because I thought, well, I understand real estate and I understand their cash flow, and they're paying, at the price, it was paying like a 10 or 12% dividend yield. And I made an absolute killing on that. I made a killing on that. Not so much in just the amount of money that I made, because I didn't bet much. But as far as the return, the ROI, oh my gosh, it would have been, I haven't checked the stock. I still own the stock. I haven't even sold it. But at one point, I think I was buying those shares for like under 10 cents. And I think I checked them a few years ago and they were trading at like 80 or 90 cents, something like that. But the dividend, based on my cost basis, had gone up like 40 or 50% because they slashed the dividend because they're having this crisis. But the stock got so cheap that even with the slashed dividend payment, it was still like a 10 or 12% dividend. So holding it for 5 years, they just increased their dividend payment back up to what it was. And then relative to my cost basis, now I was getting this annual dividend yield of, like I said, 40, 50, 60. I don't know what it was, but it was some astronomical, just ridiculous number. And that's a great example of buying panic. So the next thing here is, and this is something I had to learn the hard way. I told you one of my successes. Now let me tell you about one of my failures. I've made money in every single real estate transaction I've ever done, except one. And I got my butt handed to me because I didn't know I should buy stuff cheap. I knew that stuff, but I really hadn't formulated these 5 fundamental rules yet. So I bought some property in Ecuador, incredible property right on the beach, amazing. But then it got to and I was going to develop it, and that didn't pan out. And a couple of years went by, and then the political situation changed quite significantly. And the bottom line is I had to sell it at like a 60% loss. I mean, I just got my butt handed to me, like I said, just punched in the face by Tyson there. But what I realized is that one of the main reasons I had made money so consistently on all my other real estate investments was because I was buying things that were cash flowing. And I just thought to myself several times, I said, instead of buying that land, what if that would have been a house? And we would have the exact same thing play out. I said, you know what? I probably would have lost money because I would have been able to cash flow it. And I would have been making, let's say, $2,000, $2,500 a month. And I would have been very, very content just waiting and not selling. If I'm getting a 12% return or 15% return, why would I even want to sell? So what if the price goes down? So what if, this XYZ changes? Who cares? I'm getting a 15% return. I'm getting paid. I'm getting paid to own this. And it dawned on me right there that, number one, I never wanted to be a motivated seller because I had made so much money on motivated sellers back in 2012 when these people unfortunately had to sell their homes, most of them at a huge loss. But I was benefiting from that. So I never wanted to be that position. But in Ecuador, I put myself inadvertently in that position without even thinking about it, where I was the motivated seller. And the reason I was a motivated seller is because the property wasn't cash flowing. I wasn't being paid to own it. If I was being paid to own it, then I never, ever, ever would have been motivated to sell. I could have sat back and just wait for the market to come to me. Then when the price gets to a certain level, then you go ahead and sell. And you've got all the leverage. That's one of the main reasons why in Rebel Capitalist Pro, I always talk about my 10-80-10 portfolio. And that's why such a large percentage of the portfolio for me, and again, not investment advice, you take it for what it's worth, but for me, it's a 80%, a large percentage paying me to own it, because that gives me the peace of mind. That allows me to not only make a great market return while I'm waiting for the softballs and I'm waiting for the generational opportunities, but it allows me to really, really manage my downside risk. Because how much are you, if you never have to sell, and if 80% of your portfolio is paying you, let's say, a 10% dividend yield or 10% in rent or whatever it is, then how do you lose on that bet? It's very, very difficult. And then it's just a matter of managing your cash position. So you've got enough cash on the sideline, let's call it T-bill and chill, in order to take advantage of the softballs and the generational opportunities. Better said, or maybe said another way, take advantage of the yield curve inversions. The next one is, we already discussed this. The best investments are usually the toughest to pull the trigger. So the last one, number 5, would be something that I've been contemplating, but I've never been really able to articulate it until I listened to Ben Hunt the other day. I can't remember the podcast, but Ben Hunt is a guy that very super smart, and he studies kind of narratives. And I just thought back over the last, just since I started the YouTube channel, and I thought to myself, what if I would have faded every single narrative and used that as a trading strategy? I think I would have done very, very well. Now, this is not a secret I learned in St. Barts. This is just from me observing things. But think about that. If we would have gone back just this year or the last 12 months, and when the whole narrative was recession, if we would have faded that, we would have made a lot of money. And I'm just talking about short term now. I'm not talking about 18 months. I'm just talking about quick, 3-6 months. And I think now, if you fade the no landing, you're going to make money. It's just pretty much every single thing you think every single time that the whole market is on one side of the boat. And when you have consensus, you'd almost always make money by fading that. So that's my 5th and final rule. And I'm actually quite interested. I'm not a trader, but I'm interested maybe in Rebel Capital's Pros setting up a model portfolio. That's one of the things we do. I have a model portfolio. Lynn has a model portfolio, and Chris McIntosh, that you guys can actually follow as Rebel Capital's Pro members. But I'm thinking about setting up another one where it's more based on trading. And it'll almost be strictly narrative driven. I don't even know if I'd look at fundamentals. I would just, what's the mainstream narrative right now? And let me do the opposite of that. Seems simple enough, but maybe we'll do that in Rebel Capitalist Pro. Okay, now what I want to do is, you know what? I forgot to show you guys. Let's go back to the commercial real estate for a moment, because I wanted to share an article with you guys. Amazon says employees may not get promoted if they ignore return to office mandate. Another thing that I heard the other day, a good friend of mine, Eric Sue, is one of the top digital marketers. He's got a podcast with a guy named Neil Patel. And they have these digital marketing agencies. That's what they do. And they work with huge brands like Google and Amazon and Coca-Cola and Nike, etc. But they also work with a lot of kind of businesses that you haven't heard of, but that have a significant number of employees. So we're talking about thousands of employees. And I've listened to them in a few of their most recent podcasts. And I believe I was talking to Eric about this when he was at Eric was at our mastermind group, the last one that we had in Utah, or the second to last one. And I believe we were talking about this. And he said that not just in his own business, but all the businesses that he works for that are clients of his, he sees them bringing people back into the office. He said, George, in 2021, 2022, it was easy. He says, people were just throwing money at you. So you didn't even care if your employees were working from home on Zoom, because just money was just flowing in. So who cares? I'm getting rich. What do I care if you're working from home or not? What do I care about productivity? He said now he sees a total 180, that not only with his business, but most of the businesses that he works for, they are saying, okay, money is not coming in anymore, not like it was. We're having to tighten our belts, and we need to focus once again on productivity. And the easiest way for us to do that, bring people back into the office. So I just wanted to mention that, just kind of wanted to plant that seed when we're talking about that lesson that Steve taught me by going through that thought experiment, and why commercial real estate is on my watch list right now, and how that may, we think that office space is dead. That's the narrative right now, but maybe it's not. Maybe it's not. Okay, now let's go back to Bruce Kovner and the process. I think I want to walk you guys through this within Rebel Capitalist Pro so that you can do this on your own. I think this is absolutely crucial. So let's assume that most of us have a macro view or a fundamental view that Bruce Kovner was talking about. And let's just say that, like Bruce Kovner, it starts with the yield curve inversion right now. So what I'm doing with that macro or fundamental view is I'm sitting back, I'm waiting, because usually the stuff hits the fan after the Fed starts dropping rates. After the Fed starts dropping rates. Most people think that the stuff hits the fan, then the Fed drops rates. Not really. Usually what you see is the Fed start dropping rates. And let's go back to 2019, right? The Fed started dropping rates in 2019. Remember? I mean, we think that, oh, no, it was 2020 in March. Remember? The stuff hit the fan, and the Fed came out with their emergency meeting and dropped rates down to zero, and all these things, QE infinity. You guys know the story. But actually, the Fed started dropping rates in 2019. So if you go back in time and look at these inversions, they almost always play out by the Fed dropping rates. That's what steepens out the curve. But the majority of the declines happen after the first, not once the Fed gets all the way down to zero, but after the first rate cut. So what I'm doing is I'm looking at this, again, looking at the fundamental view of being in a long-term super cycle in commodities. And I'm T-billing and chilling, understanding that this is usually how these inversions play out. And I would consider this a generational opportunity. They have been in the past, so why should this one be any different? But then what I'm doing is I'm leveraging Rebel Capitalist Pro, more specifically Lynn and Chris, to do all the work for me, just like Bruce Kovner would do, and just like Steve does now, and just like Hugh used to do, or they still do this to a certain degree, but obviously they have a lot fewer people working for them now than they did when they were actually not retired. But then you delegate this bottoms up research to your research assistants or your research analysts. And again, this is even if you have a $1,000 portfolio, it doesn't matter whether it's $1,000 or $100 million. Concept exactly the same. The process is the same. So what I'm doing, based on these secrets that I've discovered over the past couple of years here, is I've got the macro view. You guys all know that. And then what I'm doing is I'm waiting for the Fed. And then once the Fed drops rates, at that point, I'm going to defer to the people that work for me. And that's Rebel Capitalist Pro, guys. That's what we do here. And I'm going to see what the research they've done. And I'm going to make my decisions based on their research. I'm not going to delegate my thinking to them. That is not what I'm saying. But what I do personally is I delegate the research to the bottoms up stuff, to Lynn and to Chris. So when I want to express my fundamental view or my macro view, what I'm going to do when I want to know, okay, this is happening. It's all playing out just like I thought. So now that it's happening, what do I buy? That's when you go to the research analysts that you have basically hired, which is Lynn Alden and Chris McIntosh. So if you go to the, there's a few ways to get to this. You can see newsletters and portfolios. So what I would do now is I would really start to read every single one of their newsletters, and I would start to really look at their portfolio. One great thing about Lynn and Chris, well, everyone in Rebel Capital is pro, because we got Brent Johnson and Patrick Sresna and Jason Hartman, is we all have very similar worldviews, all about liberty, freedom, free market capitalism. And we all do believe that we will have a significant commodity super cycle. So let's fast forward, assume the Fed drops rates. What George Gammon is doing is he's going in here, and probably preceding that, I'm going to be reading Lynn and Chris's newsletters to just get an idea of what they find interesting in the stuff that they're doing for their own portfolios, as far as the things that they're looking at, the things that they are contemplating. And then what I'm going to do is I'm going to look at their actual portfolio. So if we go to Lynn, this is Lynn Alden's stock portfolio. We go here, you can click her portfolio. This, I believe, takes us, this takes us to a Google Drive where Lynn updates her portfolios, model portfolios, top 12 stocks, etc. I believe she has like a dividend portfolio, and she's doing this for her members and also for the members of Rebel Capitalist Pro, every single person on this live stream. And then Chris, let's go back here. And then Chris will give trade alerts as to what he's doing for his hedge fund. And you got to remember that Chris actually manages money. He manages hundreds of millions of dollars. So he's sharing with you not just what he's thinking and the research that he's doing, but the actual trades that he's making in real time for his own portfolio, or maybe for some of the money that he manages at a professional level. So I would be hyper-focused on this stuff right now, just setting up a watch list and then waiting until it's the right time to execute on those long-term investments that I would want to hold. So again, I'm not saying this is what you should do. I'm saying this is what I am doing personally. And this is why I set up Rebel Capitalist Pro. I really set it up as a tool for myself because I know the way I operate, and I know that I'm not the type of guy that's going to go in there and just get super excited about reading the balance sheets of hundreds and hundreds of companies. Like, that's going to bore me to death. But I am the type of guy that is very, very good at understanding the overall system and then coming up with this fundamental view. And so, you know, in a perfect world, if I can come up with this fundamental view, and if I can just delegate everything else to Lynn and Chris, and then the other pros in here, then I can come to my own decisions as to when and what I want to buy. And that's, I think, the special sauce. I think that's the magic within Rebel Capitalist Pro. And in addition to that, now if we go back to this, this is the home page here that you guys can see. For those of you who are new, if you have any questions, don't hesitate to email Sebastian or Gene. They're the guys that manage this for me. But you can see the live Q&A schedule. I do one every Sunday. We've got Lynn here. She's going to be Tuesday, November 28th. Chris is going to be November 23rd. Brent, December 4th. Hartman, the 11th. And then we do a happy hour with the Rebel Capitalist Pro team, and just going over kind of what they're thinking. And then Patrick for options. And then any special things like this St. Barts Insider Secrets webinar. So this is where you can check the live streams exclusive for Rebel Capitalist Pro members. So what I would do with this is any questions that I had after going through the research, after going through the model portfolios or whatnot, I would write the question here, and I would listen to the live stream, and I would see how Lynn, Chris, any of the pros are answering these questions. And that just, that pretty much is kind of an A to Z solution for you, assuming that you're someone that really wants to kind of manage your own hedge fund, which whether you've got $1,000 to invest or 100 million, at the end of the day, that's what you signed up for. That's what you're doing by setting up and managing your own finances instead of delegating that to a passive index fund or delegating that to a financial planner. You're basically managing your own hedge fund. And so you need to have the same process. You need to have the research analysts, And then you need to be able to ask those research analysts that are working for you right now, you need to be able to ask them questions and get really good answers, in-depth answers. And that's what these live streams are all about. Okay, guys, on that note, let me go through the chat and let's see, just FYI here, Gene is saying, George, refresh his browser. Yeah, I haven't refreshed my browser, so that might look slightly different now as far as the homepage. But if you do, that's the main gist of it. And if you do have any questions on a link or, the forum, I didn't even talk about the forum where you can interact with other Rebel Capital's Pro members. That's hugely, hugely valuable as well. But if you have any question on that, always ask Gene right here or Sebastian, and they can point you in the right direction. Super, super fast. Okay, now let's go through and answer some questions, because this is pretty much what I do every single Sunday. This is what Lynn's doing. We've got the questions that you guys write in front of us, and then we just go through and answer it one by one. And then Gene has the editors put keywords to each question and answer so that you can find them very efficiently and quickly in the future without having to listen to the whole live stream. So as an example, if you wanted to know what Lynn has been saying about gold recently, you could just type in gold to the keyword, which is right here. You just type it into this search thing, and then that will take you to the clips that we have based on those specific keywords. Okay, now let's get back to it here. So first question. I'm just going to scroll through here real quick. Don't leave anything out. I hope I didn't leave anything out. I think I was very, very in depth there, and I shared all the secrets and all the insights and the epiphanies that I had, and hopefully you got a lot of value from that.
Here, I have some of the questions bookmarked for you, George. How do you identify, or how does Steve identify a once-in-a-lifetime opportunity?
I don't know if you can quantify it. I didn't ask him that, to be honest with you. I just assumed that a once-in-a-lifetime opportunity would be something like, shorting the Japanese market or playing it on the way up, or the dot-com bust, or buying Facebook in 2004 or something like that, or buying real estate in 2012, or buying commodities in April of 2020. That was one of these generational opportunities. And again, these line up almost exactly with the inversion of the curve, which is what we have right now. So that's why I think that there's a very high probability. In fact, my base case is that we have one of these generational opportunities in 2024. Where can I access this PDF? I think you're talking about the Market Wizards. Just you can go in the audiobook. Just go into, was it Apple Books or whatever it is, or what was the Amazon one that we used the other day, Josh?
They also have a free PDF online. I've already put that in the chat for him.
Oh, great. For Market Wizards?
Yes.
Okay.
You can also just look up Market Wizards book, and there'll be a free PDF right online.
Yeah, I prefer the audiobook, really. But the audiobook is on Audible, or I forgot what Apple Books or whatever the app that you have on your iPhone. Okay, guys, just bear with me. I'm going through more, trying to find some more questions here. Is this to pitch long bonds? Look, I'm not pitching anything. Take it for what it's worth. I'm just telling you what Steve is doing, and I'm just the messenger here. How did he identify booms and bust? Psychology. He would just the panic and hysteria stuff that Jim Rogers talks about. Another way that he identified kind of the bust in the Grayscale Bitcoin Trust, when you look at how much it was trading as a premium to NAV, and then how it just went down. I think it's still maybe trading under a premium to NAV. So a lot of people got wrecked there. In fact, I think that's Steve claims that's why FTX is the main reason why FTX and Celsius and Three Arrows went bust, was because of this grayscale arbitrage kind of unwinding, like the game of musical chairs coming to an end. So he was able to see that. I think he saw that one just because he has so much experience in the business, and he's seen these games over and over and over again. And now he just saw the exact same game playing out in Bitcoin or at the Grayscale Trust. He's like, yeah, I've seen this one before. I know how this ends. And so that was just through pure experience. But with the other ones, I think it was just a matter of identifying hysteria and then panic. So just observing psychology.
Here's a question. Many of these plays rely on the assumption that the status quo balances out in the long run. Example, something gets cheap, but then it goes up to a reasonable price again.
Yeah.
How do you manage the risk of an asset getting cheap and never going back up? Do you always buy assets with cash flow to offset that risk?
That's one of the reasons, for sure. But that's why I like commodities. That's why I kind of lean towards commodities, even if they weren't even if I didn't believe they're in a long-term super cycle. I might not invest in them, but that's why I would, just my personality type, I tend to favor, I guess, commodities because they can't go to zero. Oil's not going to zero. And food isn't going to zero. Soybeans or even coal, it's not going to zero. And it's most often going to mean revert because of the supply-demand dynamics with commodities. And it's just the cure for high prices or high prices, the cure for low prices or low prices. And we see that happen over and over and over and over and over and over again. So therefore, if you can utilize that and you eliminate that risk, then that is advantageous. So the good news is I favor that type of investment because you don't have to worry about that. But then also, I think it's in a long-term super cycle. Now, it is true that the producers can go bust. If you have bad management, you can go bust. But I don't really like to own these little junior gold miners as an example, unless it's the speculative side of the portfolio. That could be interesting. But as far as the investment, paying you to own it, that would not be a junior gold miner for me. That would be like an Exxon, or that would be like a Rio Tinto or something like that. So the probability of these things going bust, very, very, very low, right? And then the other thing that I would say is you got to remember this is a numbers game, and you're going to lose money. Steve loses money. But it's about having a mathematical edge. It's not about having a 100% win rate. It's just winning 60% of the time. But the 60% far outweigh the 40% where you actually lose. So there is no panacea. There's no silver bullet to where you will make money every single time. You're going to buy something that's cheap that, hey, even if it's it might go to zero. But if you take that philosophy, if you take that strategy and apply it over many, many years with discipline, and you hit these home runs, you take advantage of these generational opportunities, then you are going to come out ahead because you have a mathematical edge. Just like being the house in slot machines. There are people that walk into a casino and hit a slot machine for 10 grand or whatever, and then they walk right out. And the casino's fine with that because they know that they have a mathematical edge. So although they're going to lose some bets, they're going to win a lot more than they lose. And I think that by employing these strategies that these insiders have leveraged for quite literally decades in your own portfolio, regardless of whether it's $1,000 or 100 million, that it's going to give you an edge that other people don't have. That's going to increase the probability to a very, very high degree that you come out ahead over the long run. I mean, at the end of the day, that's really what Rebel Capital's Pro is all about.
How are you purchasing commodities right now?
Well, I would like to buy the producers, honestly. I'm not buying them now. But when the Fed drops rates, that's what I'm going to be doing. I'm going to be looking at Chris and Lynn's model portfolio, and I'm going to be asking them, I'm say, hey guys, what commodity producers do you like? What are the dividends? What do I want to build? What type of portfolio do I want? Where do I think the risk reward is? And that's how I'm going. Josh, what was the question?
How are you planning on buying
keep it up so I can
commodities?
read it.
The indirectly mining companies or by some other means?
Yeah. So ideally, I would do producers on this 10% speculative side of the portfolio. I might get into some options there, but even for that, I would defer to Patrick and ask Patrick, how to make that, how to express that bet, which again is exactly the drill, the practice drill, the simulation that we went through in St. Barts, not the last time, but the time prior to that, with all of these hedge fund managers that were going there to learn from Steve and Hugh. Fundamental view, and then we had some traders in the room, and then we asked the traders, okay, based on this, how would you place the bet? Where would you enter? Where would you exit? How would you know if you're wrong?
George, I have property in Croatia that's sitting there. The issue is it doesn't have proper internet and heating, no gas connections. It wouldn't have the wood. What would you suggest I do with it? It's on the continental part of Croatia, unfortunately, not the sea.
Well, is it just land? I'm assuming it's not a...
He is a property. It just doesn't have a proper internet, it seems like.
Okay, so it's probably like a house, I'm guessing, right? A house on a piece of land. What would I do with that? Honestly, I'd probably tell Josh to figure out a way to Airbnb it. That's probably what I would do. Or I would have Angie, who's my property manager here in Medellin, figure out a way that we could somehow cash flow it, Airbnb it. If I couldn't cash flow it like that, if it wasn't realistic, I mean, maybe you hang on to it as a plan B. But if it didn't fall into one of those categories, I wouldn't want to hang on to it. Okay, you got another one, Josh?
If the Fed drops rates by, say, 50 basis points, what is the correlation to a percentage rise in TLT?
I don't know. You'd have to look at their algorithm. You'd have to look at the algorithm and how, I'm not sure how they construct it, to be honest with you. So I would just look at a chart of TLT and see how much it went down with the Fed or with the interest rates increasing by 50 and assume that it will go down by that much. But with duration, yeah, it wouldn't be exact. That's not, as I'm thinking this through, that wouldn't be precise, but that'll give you kind of a ballpark as to what your kind of upside is, assuming that the 10-year goes from 4.5 down to 3.
Are you still thinking Airbnb might be the catalyst that makes the real estate market prices correct?
Yeah, I definitely think it could be, because normally I'd say no, because you'd have 1.5 million homes for sale. So in an average market, housing market, that's about the number of homes that you have trading hands at any given time, or at least for sale. That's the housing stock that's for sale, if you will. But right now it's only like 500,000. So you don't need a large amount of inventory coming onto the market in order to dramatically impact prices. And we all know with real estate, it's set at margin. So meaning that if you have, let's say we had 1.5 million homes for sale right now, which is kind of the normal average, and that's where the prices were, that would imply that we have normal amounts of demand. And let's just assume that 100,000 houses came online or for sale over the next year due to Airbnb, an Airbnb bust. I wouldn't be too worried about it because 100,000 isn't a huge percentage of 1.5 million. And obviously there's demand for 1.5 million. So maybe down a little bit, but I don't know if it moved the needle. That's a whole different ballgame when you only have 500,000 and demand, therefore setting the current price is at 500,000, is at all-time lows. Now, all of a sudden, if you have 100,000 hitting that housing market, there's probably going to be a significant change to even nominal prices. So I'm not saying that it will be the catalyst, but it definitely could be. I think probably most likely the catalyst will just be unemployment rate going up. We have a big recession, unemployment rate goes up, and historically you see the defaults on mortgages tied to the unemployment rate. So I don't know why this time would be any different. You know, everyone looks at the default rates on mortgages now and says, "Oh my gosh, they're at an all-time low." Yeah, it's because no one's had to pay their mortgage, for heaven's sakes. In fact, I was just looking at a story the other day in California. They're just now ending that eviction moratorium. Just now, for heaven's sake. So people don't have to pay their rent. And for the people that haven't paid their rent, the homeowners, the landlords, haven't had to pay their mortgage. That's the way that worked, assuming that their loan is through Fannie and Freddie. So this is another thing. I mean, you could go through a list of like 10 things that could increase the supply of homes to a level to where, assuming demand stayed the same, you would have even nominal prices come down. And if nominal prices are coming down in an environment where inflation is 3, 4, 5%, real terms, that's plummeting prices.
When is the next Rebel Capitalist live event?
Well, I'm glad you asked. This is, it's almost like Gene planted this question. This Monday, we're doing what do you call it, Josh? A Black Friday, but we're doing it for the whole week. So we're going to start selling tickets to the next Rebel Capitalist Live this Monday. And you'll have to listen to the videos or check in Rebel Capitalist Pro. Go back to that homepage, guys, on Monday, and I'm sure Gene will have like a banner, like here somewhere, talking about the promotion that we're doing next week. So next week only, you're going to be able to, I think it's from Monday to Friday, you're going to be able to buy tickets for Rebel Capitalist Pro at a very, very cheap price, a very low price. And so it's May 2024. And I haven't really set up the speakers yet, but one person that I wanted to reach out to early to get him on the roster, and he just texted me yesterday and said, in fact, his exact text was, "You can count me in!" ! Is Mike Green. And Josh, I don't even know if I told you that.
No, you haven't.
Yeah.
That's actually really cool. I like Mike a lot.
Yeah, Mike's awesome. So it's in Orlando, so most likely Snyder will be there. So that conversation that they had the other day on Jeff's podcast, or on Jeff's YouTube channel, was just like mind-blowing, fantastic. So as soon as I heard that, I reached out to Mike to see if he'd be a speaker at Rebel Capitalist Live. So he agreed to that. So that we're super, super excited. We're going to have an incredible lineup. But if you want to get like the early bird tickets and that special that we're doing, that's going to start next week. It's going to be next Monday through Friday. No. No, that's not what yeah, I mean, I've got a model portfolio. The question is, can you just tell us what you're buying so we can follow your lead? You're missing the point. I do have a model portfolio in Rebel Capitalist Pro, but my objective here is not to give you stock tips. You know, that's not my objective. Is to, just like the channels, is to get you thinking for yourself. It's just to give you the support system that a hedge fund manager would have to make their own decisions. That's my objective with Rebel Capitalist Pro. So, I mean, you can use it however you want to use it, but I think that you're just not capturing the total value of what we have to offer if you're just looking for, you know, my portfolio or Lynn's portfolio or Chris's portfolio and just looking for stock picks. There's so much more to it than that. And hopefully the majority of people that are here on Rebel Capitalist Pro are going to be leveraging all of the resources that we have within the forum, not just to know what people are buying and to give you ideas, but to fundamentally change or improve the way you invest from a psychological standpoint, from portfolio construction, risk management. And I think the most important part is just having the mental discipline to take advantage of those softballs and the once in a lifetime, well, the once in a generational lifetime opportunities that come up, knowing what they look like, when they are, and then based on your fundamental view, like Bruce Kovner, then you leverage Rebel Capitalist Pro to know the best way that, or to better formulate the best way to place those bets, entry points, when to exit, stop loss, what companies are the best, etc.
Commodities are pretty broad. Are there particular commodities that you feel better about than others?
Yeah, the one is lead, or excuse me, coal. I'm thinking lead because that's the example that I use with Jim Rogers in his book Hot Commodities that he wrote back in 2003. I remember I read that book, and his view on lead, that was like his favorite commodity back then. And it reminded me today of coal. Like the argument against lead back then was literally the exact same argument you hear against coal today. Identical. And then Jim just broke that down and just smashed that argument from just looking at the demand side, looking at the supply side, and then just basically saying, yeah, guys, that's what happens. When prices go low, the cure for low prices. And the reason is because there's no more money going into the supply side. Demand stays relatively the same. So then you get this explosion of prices up. And I think we're going to see the exact same thing in coal. It's persona non grata. Nobody likes it. Everyone hates it. And by the way, last time, let's think about watching CNBC over the last 6 months. And this is a question I'm asking Josh and everyone on the live stream right now. When's the last time you were watching CNBC and you saw them bring on somebody that specializes in coal? Like, oh, they always bring on the Wall Street analyst for Tesla or for Apple, or this Wall Street analyst that we're bringing on. They specialize in Apple stock or IBM or something like that. When's the last time they said we're bringing on this specialist? He's incredible, and he's a Wall Street analyst for coal. You never hear that because no one even knows what it is. Like people don't even like it. Like what that black gross stuff that I use to light a fire when I'm making a barbecue or what? That what? I'm not going to invest in that. Everyone knows we're electrifying the whole world. Nobody uses coal. Exact same argument that they had for lead. So that's, in fact, I don't want to go off on a tangent here, but occasionally I'll have an idea. Yeah, maybe I should get into trading, or at least try to trade my own portfolio. And I thought to myself that if I ever did get into trading, not just with this narrative stuff that we were talking about earlier, but really take it seriously, I think actually what I would do is I'd specialize in coal. Because who else is doing that? Nobody. Absolutely nobody. So there you would have a huge edge. I remember hearing Eric Townsend tell the story of why he started specializing in oil. Because he said, when I started trading, I knew that I wasn't going to be able to trade multiple markets because I just wouldn't have time to absorb all that information. So I had to specialize in one thing only. And I knew that the world would have demand for oil for quite some time. And that was not esoteric, but it was kind of an unloved market where there wasn't a lot of people out there. Obviously there was people who specialize in energy and oil, but not as much as tech stocks, as an example. So I think I would have the exact same mentality with coal. That, nobody even talks about it. You can't find research on it. You can't find reports, nothing. And I think that's an edge.
Are you anticipating a major shakeout of investors out of the commodity markets when/if the markets enters a major sharp sell-off in 2024? If so, which commodities would you think are most attractive during that time?
probably the ones that are going to get the most demand from all this ESG nonsense. So copper. If I could buy copper under 250, because you go look back at the historical price adjusted for inflation, and you see that when it gets under 250, it's cheap. It's like oil getting under 30. So if I could get copper under 250, I'd back up the Brinks truck on that one, because you know that on the supply side, it's going to be constrained because of ESG, and on the demand side, it's going to explode because of ESG, assuming that this push in the future is going to be similar to what we have seen in the recent past. And man, oh man, oh man, that would be just like, that would be some low-lying fruit right there. That would be a generational opportunity for sure. Other than copper, the things that go into the batteries and whatnot, nickel, lithium, etc. But honestly, again, it'd probably go back to coal, because I think that's what people would dump the first, and that's probably what would get the cheapest, and therefore that, in my opinion, would be the greatest opportunity. But I think the really sophisticated people are not the ones that are going to be selling, panic selling because of recession, but they're going to be the ones that are adding to their position or building a position because they're taking advantage of the panic. Just like I was fortunately able to take advantage of the panic that I saw in Cyprus in 2013 or 14. There are no guarantees, only probabilisms. Is that a word? I'll assume it is. Are you factoring in the probability of war? Yeah, absolutely got to factor that in. And that could be one of the main reasons why the yield curve is inverted, because all these insiders know that there's a high probability of something escalating, unfortunately, whether it's in Ukraine or whether it's in the Middle East. And if something escalates, there's going to be a flight to safety. And that flight to safety is going to be treasuries. So here's the question: is how do they decide how much of their portfolio to put into an opportunity? We didn't get into that specifically, but just I could kind of gather just broadly how they set that up. And I know that Steve and Hugh and all the guys that I talk down there, but these guys I talk to the most, say that you got to stay in the game, stay in the game. Don't go bust, don't blow up is what they call it. So just don't blow up. So I know that they would never risk enough to blow up, quote unquote. I also know that they think diversification to a certain degree is a bad word. And I know Jim Rogers, it was either the first or second time that I spoke with him and interviewed him. I asked him about diversification, and he just, no. He didn't like it. He's like, no, I don't like diversification. He says, if you really want to make money, you're going to be concentrated. And you're going to be concentrated on bets that are going to pan out and have big upside, asymmetry, if you will. So I know that Steve, as an example, would never do anything to where he would risk blowing up. But I also know that he would be concentrated enough to maximize, understanding that there are no certainties, only probabilities, therefore risk reward. He would be concentrated enough to maximize on those generational opportunities. And I can also say that it's going to be based on the timing. So are we in a generational opportunity time? Are we in a softball time? Or are we in nothing's going on? Nothing going on. And I didn't ask him this specifically, but I would bet that he would say, yeah, I'm just going to diversify because nothing going on. There's no easy pitches. I'm happy just, beating the market by a little bit here and there. And I'm just going to do this, this, and this. But when he sees that softball pitch, he's going to be more concentrated. And when he sees the generational opportunity, he's going to be as concentrated as he would ever be, understanding that he's never going to take enough risk to blow up.
I think those were all the questions.
Okay. Yeah, cool. So guys, I know we have a lot of members on the webinar right now. Thanks for being a part of the community. We love providing this service to you guys. For the new members, welcome aboard. We're really excited to have you now part of the Rebel Capitalist community. And for the new members, just as a reminder, if you do have any questions, just don't hesitate to text or email Gene or Sebastian within the forum. And if you want to check out the research, you can start right here. This little hamburger thing on the left, you can click that, and you can go down and look at the, let's see, the news. There's Lynn's newsletter. Here's Chris McIntosh newsletter. You can start checking out their research right there. You can look at the weekly Q&As, and then you can look at their model portfolios. And then the forums, you can ask other members questions. That's all. This, you can access that through this homepage. But then what most people really, really enjoy are the pro member live streams. And you can always find the schedule right up here at the top. And when you click on that, you can go to a link to watch it live. Or we obviously archive all the live streams so you can watch them after the fact. All right, guys, enjoy your afternoon. Enjoy your weekend. We'll see you in the next video.